Well, James Orlando is a senior economist at TD and has been doing some number crunching on this very subject to try to determine what happens with interest rates. James, it's nice to see you. I guess when we're trying to measure shelter-related inflation and how much of that is coming, let's say, from higher interest rates, how much is just tied to sort of our housing market, what's the breakdown? What can you tell us?
So I think this is exactly the point that we're trying to deal with here right now, is that when you look at, mortgage interest costs, obviously tied to interest rates. You look at rent inflation. That's tied to interest rates as well. You look at when landlords decide to pass on higher costs onto their renters. When they are carrying a heavier housing-related cost, they're going to pass that on to their renters. You look at even housing prices. Housing prices are directly related to, inversely to interest rates as well. So we saw when the Bank of Canada raised interest rates, housing prices came down significantly. So there's inverse and push and pull factors that come from the Bank of Canada's decisions and overall shelter inflation.
And so, some people might say, well, okay, let's lower interest rates because that should take a bite out of the shelter-related inflation. Is that too simple a way to think of it?
I think it is. When we look at, for example, mortgage interest costs, the people, for example, that locked into a 5-year mortgage 5 years ago, when they renew and say this year, next year, what's going to happen is they're still going to be looking at a higher mortgage payment shock that they're going to be experiencing. And that goes into the CPI calculation of mortgage interest costs. So it's not just Bank of Canada cuts rates and mortgage interest costs are going to drop for everyone. Some people are still going to experience a shock, unless the Bank of Canada goes back down to, say, 0% interest rates like it did in the pandemic. And you look at rent. Rent is very structural in nature in Canada right now. We've had huge population growth. We've had an undersupply of housing. And as a result, we have record low vacancy rates in Canada. And that record low vacancy rates leads us to have greater rent inflation because you have a supply-demand imbalance. And so if the Bank of Canada cuts rates, are we going to fix that supply-demand imbalance? I don't think so. And this is the issue, is that there's a lot of factors at play, structural factors, that are going to keep shelter inflation high in Canada for much longer than the Bank of Canada is probably comfortable with.
So then what, and this is, I think, part of why you were doing the research on this, what does the Bank of Canada do? Do they just sort of acknowledge that inflation conundrum and start working that into their language and just move ahead with what the market thinks, which is that we will see at least some interest rate cuts later this year? Or do they have to actually continue the fight against inflation with a laser focus now on shelter inflation?
Yeah, that's really the communication challenge that the Bank of Canada is under, because we are likely going to have shelter inflation higher in Canada through the rest of this year. And if the Bank of Canada is, as you say, laser focused on that component of inflation and how that's impacting the rest of inflation, do they cut interest rates? And so our argument is that if you look past shelter inflation, inflation is very much under the Bank of Canada's control right now. Like, we're very close. If you actually look at the Bank of Canada's previous preferred metric of inflation, we're at 2.4%. Okay, that is really close to target as we can get for inflation. Yeah. And if you look at how the overall Canadian economy has responded to higher interest rates, we've really had flatlining economic growth since last spring. And so, to me, that means that the Bank of Canada's policy interest rates their hiking cycle has worked. It means that they can start thinking, the overall economy is suffering under the weight of high interest rates right now. And everything outside of shelter is well behaved for inflation. And I think if the Bank of Canada can speak to that and say that, we're looking at the direction of inflation, over the next year, and we're seeing that we think things are working. We think that things have moved in a way that we believe that future inflation will come down. That will open the door for them to say, we recognize that shelter inflation is high. It probably will remain high for the foreseeable future, but we believe that the direction is right, and we were able to cut interest rates. And that's why we still have cuts by the middle of this year, and not waiting, for example, until the end of 2024 or into 2025 before they start cutting interest rates.
Well, I mean, we might have a shelter inflation challenge. We have a debt challenge too, right? People had to put a lot of money, borrow a lot of money to get into the market in the first place, and that's hard for us to ignore when we're trying to figure out what happens to an economy when interest rates climb rapidly. Have you plotted a scenario where, though, in theory, even though it's not your base case scenario, that arguably the Bank of Canada could put off cutting interest rates?
Yeah, so we made three scenarios. One is where they cut in March, so they cut like a few weeks from now, see what happens there. We have one where they cut in June, and then we have one where they delay cutting all the way until December of this year. And so what we found is that things like mortgage interest costs, obviously you get some relief by cutting early, and whereas if you don't cut and you wait till December, you're going to be hitting the people that have, high debt loads that are potentially resetting this year on their mortgage rates. And we've actually done some side analysis on this mortgage interest rate issue, where we look at people that have mortgages and see how much they've cut spending on the year in which their mortgage reset happens. And we found that people, for example, in 2023, the reset on mortgages have cut their spending significantly. And we've also found that people in 2024 that are about to reset haven't really cut their spending at all. So we're in for a challenging situation for those people that are looking at mortgage resets this year. And so you take that into calculation. You say, okay, mortgage interest rates are going to impact people in Canada through the rest of this year into 2025. And then you look at rent, and we look at the undersupply that we have. Yes, building has ramped up in the last little while, but the supply imbalance isn't going to fix itself anytime soon. And so we're still going to have rent inflation well above what the Bank of Canada is comfortable with for the foreseeable future as well. So these two major components are going to be driving overall shelter inflation higher, notwithstanding the fact that obviously we have this other component, which is how much house prices cost in Canada. So we have something called homeowners replacement costs, which is effectively what's the price of if you have to replace your house. So effectively a price of a new home. And if the Bank of Canada cuts rates early, we're likely going to see more of a ramp up in housing activity in the spring buying season than you would otherwise have. Whereas if they say, no, we're not cutting rates until the end of this year, that's probably going to slow that demand. But it's not enough to offset the fact that we're going to have these other components, mortgage interest costs, rent costs, driving this index higher for the rest of this year.